Hello everyone, in this part of the course we'll talk about patterns of technical analysis. The patterns or forms of technical analysis often appears on the charts and in all time frames. They can be divided into two criteria and those are the trend reversal patterns and trend continuation patterns. Regarding trend reversal patterns, we'll explain head and shoulders and double top, double bottom patterns. And as for trend continuation patterns, we'll explain flags, triangles, and rectangles. Let's start with pattern head and shoulders. Head and shoulders is one of the most popular forms of technical analysis and very often may indicate the trend reversal. This form, besides indicating a potential trend reversal, can provide an accurate signal to enter the position with the defined stop loss orders and targets. Patterns head and shoulders in the growing trend provide signal for short, while in the decreasing trend provide signal for buy. It can be effective on all time frames. It consists of three parts: the left shoulder, head, and right shoulder. These three parts are connected by a trend line that is called the neckline. According to the rules, left and right shoulder should be approximately the same size. In the growing trend, right shoulder should be a little higher and to form a higher peak compared to the left shoulder, while in a decreasing trend, the right shoulder should be located in a lower position than the left shoulder. A very important rule if you trade using head and shoulders pattern is to wait for the pattern to be completely formed. It means that position should not be made until the price breaks the neckline. Many traders do not even enter the position after this point, but wait for the price to make return and test the neckline and then make enter into the position around neckline area. Were you going to make entry into the position immediately after a price breakthrough to the neckline, or wait until the price tests the neckline is completely up to you. Those who are more inclined to risk would prefer to decide immediately to enter the position to achieve higher profit, but there is a high risk because at the market often occur false breakthroughs. What actually happens? Many small traders after a breakthrough enter into short, then the big players, by entering the opposite position, push the price up and take money picking up their stop loss orders. That is what has happened in this displayed case. After the breakthrough of the neckline, more traders have entered into short position and their stop loss orders were placed just above the neckline in reason to earn as much as possible profit with a low risk. But in this situation, they found themselves in a big player's trap who have the power to move price in their direction. If you look carefully, you'll notice one candle that is formed by a large tick and has very small body. It represents previous situation. The price was pushed up for a short period, just enough to close the stop losses of small traders and then return in the right direction. Therefore, our advice is to stay out of the trade after the breakthrough of the neckline and wait until the price comes back, testing the neckline or get close to the neckline zone and then enter into position. As far as the stop loss, it also depends on you, your strategy, and your money management. Our advice is to put the stop loss above the right shoulder in a growing trend and below the right shoulder in a decreasing trend. As for the take profit, it can be lent from the neckline to the top of the head of pattern. Our recommendation is that the stop loss should be moved to a level of entry into the position when the price falls for a high of a shoulder. And then you have trade without a risk. You can't lose anything, and if the price continues to fall, you can earn a lot. This is called trailing stop. Move the stop loss when price moves in the direction that you want to reduce the risk or even ensure a certain profit. Now we'll explain the reverse head and shoulders pattern in a decreasing trend. This shown pattern is on the pair Euro-US dollar on the 60-minute time frame. We see two shoulders that are roughly the same size, and the right shoulder is now a little lower than the left according to the rule. We see that the left shoulder is not really ideal because few candles broke the neckline, but it doesn't matter because you will rarely find the ideal situation on the market. What is important is that the price after the formation of pattern and breakthrough neckline made a return on the same line and give us the ideal situation for entering the buy position. Stop loss is placed under the right shoulder and target is the high of the neckline to the bottom of the head. We see that the market with a vertical black line. As you can see, the price has, after entering the position, taken a big jump and achieved our desired target. Although we said that the pattern often indicates a trend reversal, in this situation it did not happen. After achieving target, price has continued with a downtrend. For this reason, we suggest setting targets or take profit orders in the level of the head patterns, or perhaps better to move the stop loss as explained in the previous case. Now we will move on the platform and open pair Euro US dollar in a 4-hour time frame. If we analyze the graph, we'll see a pattern head and shoulders in a downtrend, which means that we have the signal for buy, because this is the reverse head and shoulders pattern. The first thing we notice is that each new bottom is lower than the previous, which means that it is a downtrend. Then we see tree formation that indicate a reverse head and shoulders pattern. We'll connect these tree formation with one trend line and get our pattern. Right shoulder is slightly lower compared to the previous, and both shoulders are about the same size. After the breakthrough of the neckline, price returned, tested the neckline, and then made a huge jump. This is an ideal head and shoulders pattern. To more clearly notice a pattern, we'll mark its elements. Entering into position would be in the area of the neckline. Stop loss below the right shoulder, and the target is a height of the head of the pattern. Unlike the previous case, where the price continued to downtrend after achieved targets, we see that there has been a trend reversal because the price made a significant growth compared to the most important peaks in the graph. Although the price in this case made a much bigger jump compared to our target, our advice is to place take profit at the level of the head height of patterns or use trailing stop to ensure profit, because this ideal situation on the stock market rarely occurs.